Making money is great. Not losing money is even better. I know you want to make as much money as possible in the shortest amount of time. I get it. Who doesn't want to be rich now? But you need to stop pretending like risk doesn't exist. I have a student in my program right now, and before coming to me, she had actually invested into this real estate fund, and it was a development fund. And honestly, that's not something that I would ever personally invest into. Why? Because while they are saying, oh, you can get these really great returns, you can make 30% on your money, 40% on your money, what they're not explaining to you is the reason why they are saying you could potentially get these returns is because you are taking on an excessive amount of risk, meaning you can lose your money. And that's exactly what happened to her in this instance. She lost 6 figures. Why would I never touch a development deal? Because typically when developers are coming to the public to raise funds for their project, it's because they're trying to finance something that the bank wouldn't finance. So the bank will finance the land, the bank will finance the buildings, but the bank's not going to finance the soft costs. Think things like the sales team and the marketing. Why won't the bank finance those things? Because if shit goes south, they have no way to recuperate their money. So they're like, okay, if shit goes south, I can sell the building, I can sell the land, can't sell the sales team. So if you are only ever chasing returns without understanding what you are actually investing into and why, and what are the potential downsides, like you need to go into every deal, into every investment being like, what are all of the things that can go wrong? Am I setting myself up in a way that I'm protected from it? Because again, making money is great, not losing money is even better. I have another student question today that I need to answer on my coaching call. He's telling me that he wants to use a securities-backed line of credit to invest, which is inherently risky. Basically, that's a loan against your stock portfolio. Let's say these lenders will give you up to 50% loan to value, meaning 50% of what you have invested is loanable. If the market drops by 35%, like it can and it has in a bear market, they will issue something called a margin call, which means you either need to put more money in right now or they're going to sell your investments at the worst possible time while the markets are down. That means you lock in your losses. You have no chance at riding it back up for a recovery. The average historical return of the stock market is 10% a year. Anything promising you or saying that they're going to give you more than 10% a year, be very fucking wary, because it means they are taking on excessive risk to get to that point. And you need to ask yourself, am I comfortable losing all of my money for the potential at making more? Because when you start thinking with greed, that is when everything goes wrong. And it's no shame to these people. I get it. You want more money. You want more money now. You want it quickly. But the way I teach investing is not gambling. It's not going all in and not understanding the potential downside and the potential risk, because I want you to make money, not lose it.